What if I told you there's a Buffett-style ETF out there, not operated by Warren Buffett himself, but built on his principles that pays you a whopping 15% dividend yield? That's not a typo, 15%. And here's the kicker. It could outperform JEPI, Wall Street's current dividend darling. So, if you've been looking for high-yield, low-stress income in this volatile market, you might have discovered your golden goose. Today we'll look at an ETF that's making waves in the investment community, SPYI, which boasts an impressive 15% dividend yield. SPYI combines the reliability of S&P 500 investments with the earning potential of covered call strategies. We'll study its structure, compare it to JEPI, and determine whether it belongs in your portfolio. SPYI, established by NEOS Investments in August 2022, is intended to provide high monthly income by combining S&P 500 equities exposure with a sophisticated option strategy. The fund invests in S&P 500 constituents, including tech behemoths like Apple, Microsoft, and Amazon, to ensure broad market exposure. SPYI uses a covered call strategy to increase income by selling call options on the S&P 500 index and collecting premiums. This strategy creates additional revenue, which is delivered to investors on a monthly basis. Currently, SPYI yields roughly 15% annually. Let's put that into perspective. If you invested $10,000 in SPYI today at a 15% yield, you'd receive $1,500 in annual income, or approximately $125 per month. That's more than most Americans earn from a part-time side hustle in 5 years. Assuming the yield holds and prices remain consistent, you're looking at $7,500 in cash income, a 75% return on your initial investment just through dividends, without even factoring for price gain. Let's compare that to the J.P. Morgan Equity Premium Income ETF, JEPI. JEPI has proven quite popular among income investors because to its consistent monthly dividends and low volatility, its current yield is between 9 to 11%. While JEPI is generous, it does not quite match SPYI's enticing payouts. But what about the risk? Well, SPYI and JEPI have comparable DNA. Both use covered calls, are spread across the S&P 500, and are intended to appeal to income investors seeking stability. Here's where SPYI harnesses its inner Buffett. It does not seek speculative profits. Instead, it achieves broad market exposure through index investing, as Buffett suggests, and then magnifies it with option premiums. It's like taking Buffett's standard advice, buy and hold the S&P 500, and giving it a boost in income. Now, let's address the elephant in the room. How sustainable is that 15% dividend? The yield does not come out of thin air. SPYI can achieve such large returns by receiving regular revenue from option premiums. During moments of high market volatility, these premiums might grow significantly. Even in very flat markets, covered calls can capture recurrent premiums with low drawdown. SPYI's monthly distributions are not guaranteed, but they have stayed very constant and strong, making it an appealing alternative for retirees or anyone wishing to live on dividends. However, no ETF is free from risk. If the market enters a lengthy, powerful bull run, covered call strategies such as SPYI may underperform in terms of total returns, since they trade off upside potential for income. That's the trade-off. You forego the rapid gains of tech rallies in exchange for consistent monthly income. However, if cash flow is your primary goal, this trade-off may be advantageous. After all, how often do we see 15% yearly income combined with the stability of blue-chip S&P 500 exposure? Let us also zoom in on the numbers. The NEOS SPYI fund currently has a net asset value of approximately $50 per share. Monthly distributions range between 0.60 and 0.65. At $0.65 each month, this equates to $7.80 per share yearly. Divide that by the share price, and you obtain a dividend of about 15 on 16%, depending on market changes. And yes, those reimbursements are made monthly, providing you with consistent income to cover costs, reinvest, or simply have peace of mind. Some people may wonder, why not just invest in high-yield dividend stocks? You surely can, but most dividend aristocrats cap out at 3 to 5% yields. If you want 15% returns on specific equities, you're probably getting into speculative or dangerous terrain. SPYI exposes you to a diverse basket of major U.S. firms, such as Apple, Microsoft, and Amazon, but with the added benefit of options income. Here's another Buffett-like twist. SPYI is tax efficient. Unlike many income ETFs, it uses tax loss harvesting tactics to offset capital gains, lowering your tax bill in April. Even the Oracle of Omaha would approve of making more while legally paying less in taxes. Is SPYI superior than JEPI? That depends on what you want to achieve. If you want a steady income with less volatility, JEPI is a good alternative. However, if you want to maximize monthly cash flow with a strategy based on market fundamentals, SPYI may just edge it out. In recent months, SPYI has beaten JEPI in terms of yield and capital preservation. Of course, past performance does not guarantee future outcomes, but the data speak eloquently. Assume you're constructing a $100,000 dividend portfolio. With a 10% yield, JEPI would generate $10,000 in annual income. SPYI at 15%, that increases to $15,000 per year, a $5,000 difference. This is enough to cover a used car loan or a portion of your rent. Over 10 years, that's $50,000 in extra income. And if you reinvest dividends, the difference is much more. Don't forget Warren Buffett's 2 golden guidelines for investing. Rule 1, do not lose money. Rule number 2, do not forget rule number 1. SPYI adheres to that principle by reducing downside risk with its covered call overlay, while still providing growth through market exposure. It is not a get-rich-quick technique, but rather a method of getting paid consistently. Now, there's speculation about whether SPYI can sustain such a high yield in the long run. The truth is that, like any other options-based ETF, yields may fall as volatility and option premiums reduce. However, given the present market conditions and the fund's aggressive management philosophy, there is still plenty of opportunity for high income generation. NEOS, the fund manager, actively modifies strike prices, expiration dates, and tax techniques to maximize efficiency. This is not a set-it-and-forget-it fund. It is actively managed to ensure consistent results. If you're new to investing or searching for a passive income stream, SPYI could be the ETF you didn't realize you needed. It combines the safety of the S&P 500 index, the power of monthly income, and the discipline of covered calls. It may be one of the best high-yield passive income plays available today, in addition to outperforming the JEPI in terms of yield. However, as usual, conduct your homework and assess your risk tolerance. To summarize, the SPYI ETF is making big waves. With a 15% dividend yield, monthly distributions, and a Buffett-like investing foundation, it's reinventing passive income in 2025. Warren Buffett may not run it, but it adheres to his ideals of good foundations, steady returns, and long-term thinking. If you want to live off dividends or just want a better strategy to build income without the volatility of individual companies, the Buffett ETF with a 15% yield could be your next big move. Just don't blink. Possibilities like this don't endure forever. Make sure to subscribe for more deep dives like these. Share your thoughts in the comments. Do you believe SPYI is superior to JEPI? Would you include it in your portfolio? Let's speak about strategy, numbers, and smart money moves. Thank you for viewing, and see you in the next one.